This is TreppWire Week in Review for the week ending July 14th, 2023. I'm Haley Keene with Trepp, a data, modeling, and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, U.S. stocks rallied, and Treasury yields tumbled as CPI came in cooler than expected on Wednesday, and PPI followed suit on Thursday. Investors piled into equities this week as a consensus emerged that the 2022 and 23 inflation scare is behind us. In addition, some early company earnings reports came in better than expected, adding more fuel to the fire. Delta Airlines posted record revenue, and Pepsi beat earnings estimates and raised future guidance. Manus, is this the start of something bigger, or are the markets getting ahead of themselves?
Well, this was a very, very interesting week in that for the last 6 months, or for most of 2023, any enthusiastic response to falling interest rates, cooler inflation numbers, decent jobs reports has really come from the equity markets. And within the equity markets, it's really been a very narrow band of stocks that have driven the indexes higher. The big 10 stock names have really been responsible for an outsized percentage of the gains we've seen this year. This week really felt like an inflection point. Whether it sticks or not remains to be seen, and I will try to break it down as efficiently as I can. So last Friday, we saw a jobs number that was kind of middling. That gave hope to the fact that maybe inflation was not out of control. That was followed up this week with a cooler than expected CPI number, the 12th consecutive dip for that particular index. Today, another really benign PPI report. So for the last 2 days, we've seen risk on for stocks. The indexes have really surged. Tech has outperformed, as it usually does when rates fall. The NASDAQ is up between 3 and 4%, if I'm not mistaken, over the last couple of days. So that's kind of the narrative we've been expecting throughout 2023. Lower CPI, lower PPI, stocks take off. So why was this week different? It was different on two fronts. Number one, as Haley alluded to, we saw better than expected earnings from Delta and from Pepsi. That gave the market rally some breath. We saw some consumer staples, like we're saying, Pepsi and Delta, really outperform. In Delta's case, record revenue. In Pepsi's case, beating on earnings and also raising future guidance. Great information as well. It kind of girded equity investors to put even more risk on. I still haven't gotten yet to why we're at an inflection point, but I will right now. For the entirety of 2023, bond market investors have looked at these rallies with skepticism. While spreads have tightened, the enthusiasm for credit has not been there in the same way it has been for equity prices. Equities have taken off, bond spreads have not collapsed. That changed this week. What we saw over the last 2 or 3 days was not only Treasury yields plummeting, and Treasury yields have come down a lot this week, 30 to 40 basis points for the 2-year and to the 10-year. That's been a nice rally there. But BBB minus spreads for both CMBX and for cash absolutely fell off a shelf this week. CMBX spreads for some indices at the BBB minus level, for indices 10 and 11, which would be like 2015 and 2016 vintages, fell 130 basis points. Cash CMBS BBB minus spreads tumbled probably 50 to 60 basis points. What that is telling us is that commercial real estate bond investors, fixed income investors, are joining the party. They believe that there's reason for enthusiasm right now. Now, is that enthusiasm warranted? Time will tell, right? Certainly inflation is coming down. Certainly unemployment is not going up at the level that we thought we would have to see to corral inflation. Earnings so far in this little window of 2 or 3 days have been better. If this continues, I think bond investors, credit investors might be onto something, that maybe a soft landing is out there, and maybe those that have put risk on in advance of this rally were right. We'll see.
Yeah, you covered a lot there, Manus, but I agree with the sentiment. I think this week really aligned itself with kind of that taking off in the markets of, risk on. Maybe we are going to get the soft landing. At this point, I think 25 basis points, everyone that I've seen online, their take is that we maybe get 25 basis points and that's it. The hawkish talk maybe turns into a muted 25 instead of 50. To add to some of the earnings, you mentioned Delta and PepsiCo. Delta's net income for the quarter came in at 1.83 billion, which was up from 735 million the previous quarter. And I think, as you mentioned, record for them. And then PepsiCo revenue was 22.3 billion versus an expectation of an estimate of 21.73 billion. So good news for them. And as you mentioned, they raised their outlook. If you look at Amazon Prime Day, that happened this week. It's always interesting. They call it Prime Day, but I think it's like a couple of days. So it could be Prime Week at this point because they actually have a few days prior to Prime Day where they start listing sales. But online sales rose about 6% to 12.7 billion during what they're calling the Prime Day promotion. And that's according to Adobe Analytics. Amazon reported that people bought more than 375 million items during Prime Day. Some context, last year, there's about 300 million goods sold, so 75 million to the good there. Home goods, fashion, and beauty were the top categories during the event. You hit on some of the headline inflation, eased to 3%. I think that's a net positive. If you look back to June a year ago, inflation was at the peak at 9.1. Average gas prices were $5 a gallon. We were in a much different place than where we are now. If you look at airfares, they plummeted 8.1% in just a month. Used car prices have also fallen. New car prices are flat. And then some of the critical services like rent that have been really kind of keeping inflation higher than what everyone would agree, maybe the number would be without that lagging indicator. They've showed a pretty rapid decline. Really, we're starting to see the effect of that in the overall number. So all in all, I think it's a good week. I think my sentiment has maybe changed in outlook in regards to the soft landing. I think the soft landing is probably now more probable than not. And it'll be really interesting to see what happens later in the month. I think if we get another 25 basis points and that's it, I think the markets return to normal and we might see, activity really picking up across the spectrum.
One of the beauties of the last 3 years being in this seat and being able to do the podcast and have the audience we do is that I've met so many new people, and so many of these people come to me via Twitter or LinkedIn and share their thoughts about the market. And it's a really diverse group, right? We have what I would call permabulls, people that are always enthusiastic, that think the glass is always half full. I would say we have those people in the middle that kind of look at the data and make their judgments as they see fit. And then there's people that kind of tilt bearish and kind of see the glass as half empty. And I communicate with a lot of them during the course of the week. And the one thing that struck me this week was the people that tend to tilt bearish, that always look at the data and kind of focus on those data points that are evidence of cracks or evidence of weakness. They even kind of the people that kind of demonstrate that sentiment over and over again had to admit that this was a different week, that the tenor really changed among people. And let's face it, bond investors, credit investors, generally by nature are more cautious people, right? They tend to see the glass as half full. They think, right, credit issues are right around the corner. If everything works out perfectly, all they do is get their money back. So in this case, we saw a lot of people in that market think, wow, this was really some extraordinary rally for credit this week. And there's no sugarcoating this, or what's the opposite of sugarcoating? There's no other way to describe this other than people got really comfortable taking risk this week. And that's a big difference. One thing I would point out is sentiment is different than reality, right? We are all risk on right now. We are all in. Bond investors, equity investors, we're all in. And what happens next, we just don't know, right? We have to watch the data. We have to watch the earnings. We have to watch what happens in the CRE markets. And I would caution people, right? We had moments like this between Bear and Lehman in 2008. And while enthusiasm is wonderful and we all love watching the markets go up and spreads collapse, time will tell. We will have to see. We're in the really embryonic stage of coming out of this inflationary, Fed-driven rate hike window.
Yeah, I'd say it's way too early for victory laps, but there is definitely a sense of optimism. And from a CRE perspective, even if things turn positive, there's still a lot of these properties that are going to face some pain. There's still some distress that's going to have to work its way through the system that we are just fairly on the front end of that cycle. So I would temper the optimism slightly when it comes to CRE, just because we're in a higher interest rate environment. I think we're going to be higher for longer. Even if the overall market sentiment has changed, some of the underlying fundamentals are different now than what they were 3 years ago. And that's going to have to, play itself out through the market cycle.
So let's dive in just a little bit more into what this lower interest rate twist for this week has meant. We've talked about this in the past, but not very recently, that CRE borrowers get their rates from a combination of two things: where treasuries are, right? The risk-free interest rate that treasuries provide, plus a risk premium. For people that have been in the market for a long time, that's well known. For people that are new to the market, maybe that's somewhat new. But the risk premium you get is a function of how risky your property is, right? If you are or your, the company, the condition of your company, right? Your lending spread, if you are a AA rated company, is going to be considerably less than if you're a BB company, right? That's just the way the markets work. They price risk accordingly. And the CRE markets blend risk for lending, which is a combination or a scale of both that risk-free premium and a credit spread. And this week, at the top of the curve, we saw spreads drop, AAA CMBS spreads drop, let's say 5 to 10 basis points. So when you add that to the fact that the 10-year treasury is 30 basis points lower today in yield than it was a week ago, you're borrowing at 40 basis points lower today than you were a week ago for a really high quality property, right? Down the curve, the move was even bigger. That 30 basis point yield drop combined with what is probably a 75 or 80 or 90 basis point drop in BBB minus spreads means that for properties that are cuspy, your borrowing level probably came in 75 basis points this week. That's a real home run for people that, were facing maturities, that had cuspy properties, that were looking for handles in the 8s, mid 8s, high 8s. This was a great week for you.
We started to see an uptick in the issuance before this, and hopefully this just continues to bode well for some of that coming online.
So this week, there was some interesting news articles surrounding commercial real estate. Let's pull back some of those articles and talk about what it means for the market.
Yes, I've been kind of completely bullish and optimistic and exuberant for these first 10 or 15 minutes of the podcast. I'll taper that back just a little bit with one of the articles, and then I'll point out a second one, which I thought was really interesting. Two great articles, actually, one from The Real Deal and one from Commercial Observer, that are really well worth people digging into, and I'll go through them in succession. The one which brings up concerns, which I think you probably saw, Lonnie, there's two of them actually, that talked about multifamily borrowers that have gotten over their skis by borrowing in the CRE CLO markets. The first one came out, which was very specific to Tides Equities, and talked about how much they had grown in the last couple of years, how much of their debt was floating rate, and how they had warned their investors that capital calls might be coming down the road. The Real Deal followed that up with a more extensive piece where they named 4 other firms that followed the same business model, that also took on a lot of floating rate debt, had grown substantially over the last 3 years, and might be in that same boat as Tides Equities, which is not to say that any of these firms are, facing imminent liquidity issues or anything like that. But it was a warning sign of something that you've pointed out, Lonnie, several times over the last year, which is multifamily borrowers that have taken on leverage using floating rate debt, right? If we're going to see cracks in that multifamily market, that might be where we start seeing it. What were your thoughts on those pieces?
Yeah, so I think from the article's perspective, wasn't a bunch of new content for us. We've talked about this for some time. I think the way they organized and kind of went through it, kind of tells the tale. I mean, the reality is a lot of these investors bought massive amounts of properties, got themselves in floating rate situations, assuming that that was a better play because of where rates were, that they were going to be better off with the floating rate debt. And they're really, maybe in a tough spot. I think, the deal is they're on the ropes. The reality for them is, as an operator, though, if you're taking the positive side of this, if there is one, is that these are by definition story loans, value add properties, repositioning, and that process does take time. And nor Trepp or anyone else has actual real-time data in terms of day-to-day leasing activity and so forth. So the data we're getting is near real time, but it is somewhat dated relative to what's taking place on the ground. So those operators, if they have an execution strategy, they're going to know a little bit more than what we are or anyone else that's reporting on this relative to how they're actually executing on that. With that said, the DSCR, the LTV on a lot of these deals don't lie. That's the reality based on the performance of the property. And to date, a lot of these are really in distress. And if you look at the markets they're in, this is one of those things where hindsight, we're going to look back in 24 months or 36 months, we're going to say, here are the 4 or 5 markets and the 4 or 5 operators that really just got over their skis. And it's easy to identify now, but maybe in the moment it wasn't for them. I'm kind of a fundamentalist when it comes to this. When you see people that have come on the scene and they're kind of somewhat not known, and then all of a sudden they're one of the top 5 or 6 or 10, acquisition operation firms in the market, I think you can grow too quick, too fast. And I think for some of these folks, that's what we're seeing play out. And some of it's just bad timing. They got in the deal. There's no real differentiation, value add, broad brushed, changing cabinets, counters, flooring. At some point there's a lifespan to that. And I think some of these folks just got in too late and they got debt that's unfavorable based on the market. And it's going to be a challenge for them, and hopefully provide some opportunity for some other folks that are capitalized on the sidelines now that can come in and realize the upside.
Yeah, I want to give credit where credit is due. In the case of The Real Deal, I think these publications are terrific, by the way. The Real Deal, Commercial Observer, Cranes, really just do terrific jobs in terms of following commercial real estate. I'm an avid reader of all of them. In the case of The Real Deal, Isabella Farr has been following the story, and she came out with another piece today, which pointed out that AMC Investments has been the largest source of capital for Tides equities, more than $300 million put to work as an investor in the Tides assets. So look for those stories. The other story I wanted to touch upon, which has nothing to do with the CRE CLO market or multifamily, but I also thought it was worth people looking out for. This comes from the Commercial Observer. We've talked before about properties going back from the borrower to the lender taking ownership of these properties because the borrower no longer wants to fund shortfalls, can't refinance, has watched debt service coverage ratio and occupancy plummet. This Commercial Observer article, which quotes a lot of big names, including Shlomo Chop and Rob Verone in the piece, talk about really the X's and O's, about how one gives back the property. We joke about the term jingle mail, where one day the keys are coming back to the special servicer and that's the end. And Shlomo Chop and others were quick to point out that there is a process that has to be followed legally in terms of not stepping on landmines, in terms of breaking agreements with tenants or with lenders that can turn a non-recourse loan into a recourse situation. So for those that think that giving back the keys might be part of their strategy or something they are forced to do down the road, this is a great primer for getting inside the minds of the lenders and people who have been down this path before. And I urge you to read it.
Yeah, I would agree with you, man. I thought that was a really great piece. And I think some people have a misconception that non-recourse means no impact. And the reality is, even when these non-recourse deals go back, there's tax implications, there's other implications, and it's not a quick process. I mean, by definition, there's a lot of interested parties and there's a lot of people working to try to achieve the best interest of the fiduciary, like for the fiduciaries that they're representing. And so it's a really great piece. If you're unfamiliar with CMBS market or just how, properties that go into distress play out, I would agree with you. This is a great read.
You used a word just then that I don't want to neglect, that tax word, that we had a listener come to us and talk about in email form how important an issue this is. And we don't have the time this week to get into it to the level of detail that we need to. And maybe we should bring in an expert to go through the nuances of it. But suffice it to say, and Lonnie, you could add your thoughts to this, that your basis for where you bought a property, how much accrued appreciation that you have in an asset will likely determine how hard you will fight for this property, right? If you bought something for $10 million in 1975 and have watched it appreciate to $150 million today, and you have not paid any taxes on that because you haven't recognized any sales income, and you've borrowed against it every 5 or 10 years with more and more debt on this property, giving back the keys will have a very important tax implication to you that would not be felt by somebody who bought a property in 2013 that saw only limited value appreciation over the last 10 years. So we'll get into more of that at some point over the summer, but that will certainly influence how borrowers approach whether or not they want to hold on to these things, and what tactics they take and what decisions they make when deciding whether to give back offices that may have been worth X 5 years ago and now are worth 70% X. We'll get into more of that, we promise, as the summer goes on.
So let's turn to bank earnings. Our banking team here at Trepp actually wanted to get an early read on second quarter earnings. So they consulted our capital adequacy stress testing model to see what it would predict. Lonnie, what were some of those findings?
Yeah, so the model is actually projecting strong increase in second quarter earnings broadly, even higher revenues for the largest banks, with a projected increase of 18.5% versus Q2 of 2022. And if you look at last quarter, about a 19.8% increase when compared to that. If you look at net interest income growth, it's definitely slowed. The TCAS model predicts a year-over-year increase of 6% in Q2 of 23 as compared to 35% in Q1 of 23. Non-interest income had been a soft spot for banks in 22. Double-digit declines as stock and bond markets slumped. TCAS model predicts a turnaround in the second quarter of 23 with about a 34.1% increase as compared to a 4% increase in Q1 of 23. So for those of you listening that just heard a bunch of numbers get rattled off, don't worry, we're going to have some stuff released on this where you can actually read the full insights. So you'll get this information more than just the audio version on the pod. Net charge-offs have been on the rise. Sour consumer loans leading to an increase. So have already increased their loss reserves. TCAS models predict a modest decrease of half a billion in loss provisions from Q1 of 23. So a lot of interesting nuggets from the model. If you have questions about this, feel free to call in or reach out, email. We'd love to get you on with one of our banking experts, and we can walk through some of the tools that we have that could maybe help with, making some projections around how banks are going to fare from an earnings perspective.
Now let's turn to the hotel market. We actually saw a big story on Friday, but that was after our podcast. So if you were a Trepp client, you would have saw a trading alert come out about this on Sunday. But let's walk through what we saw with Ashford Hospitality Trust.
So this was a big deal that was issued in 2018. It's a somewhat complex deal. It was an Ashford Hospitality Trust securitization of 34 hotels that were split up into 6 different pools. The loan went delinquent last month. We talked about this when we mentioned the delinquency report, how this one particular loan going delinquent led to a really sharp uptick in hotel delinquencies last month. The news that came out over the weekend or very late Friday, and we published some information on it over the weekend, was that the owner of the hotel had basically bifurcated their 6 pools. 3 of the pools, they announced that they were unable to meet an accommodation with the special servicer, and those particular hotels will now go deed in lieu. The borrower will not look to hold on to those. They will be given to the lenders, and those things will become eventually REO, absent a change in heart from the owner of the properties. So these are considered pools A, B, and F. Some of the hotels in these markets, if you're a hotel buyer, if you're looking for REO hotels down the road, some of the locations are Las Vegas, Newark, California, Hawthorne, California, Phoenix, Scottsdale, Oakland, Basking Ridge, New Jersey, Bridgewater, New Jersey, Atlanta, Durham, Flagstaff. So it's a real wide litany of hotels for which the owner is giving back the keys or is planning to give back the keys to the lender. Now, there's 3 other pools for which the owner said, we're willing to put in a lot of money for these properties to buy down the amount of debt outstanding so that we could meet the debt yield requirements needed to extend the debt. 3 other pools, pools C, D, and E, the owner is leaning in. So pool C, these are hotels in Coral Gables, Fort Worth, Bloomington, Minnesota, San Diego, and Langhorne, Pennsylvania. The owner paid $62 million to pay down principal in order to meet debt yield tests and hold on to these particular properties. Pool D, hotels in Los Angeles, Atlantic Beach, Florida, Dallas, Texas, Santa Fe, and Herndon, Virginia. The owner had to pay $26 million to pay down principal to retain ownership of these. And for the last pool, this is hotels in Fremont, Philadelphia, Memphis, Anchorage, and Lakeway, Texas. The owner had to pay $41 million to extend the loan. So in all, about $130 million had to be paid from the owner's Braemar Hotels, which took over the hotels from Ashford a couple of years ago to own these things. So when we talk about the cost of higher debt service and the cost of interest rate caps, this is where rubber meets the road. To keep just half of the hotels that they wanted to keep, this particular entity had to pay $130 million in principal reductions to keep these assets.
Yeah, it's pretty remarkable the amount of capital that was required to keep these going. You know, I haven't had a chance to do a bunch of research on these, but as you were going through the story, Manus, do you think there's a longer term play here around the underlying geographic location of the hotels that they're willing to lean in on? Or do you think it was maybe just a byproduct of those were the hotels that, maybe had their PIP plans implemented, were in better, physical shape, and they felt like just had a better return opportunity, from a resale perspective, maybe at the end of the term? Or what do you think maybe led to some of that bifurcation and decision by the owner?
Well, I think you're spot on. I think that in every case, as we've said before, there's not an emotional tie to these hotels. There's just numbers. You'd like to say it's just math. And I do think that the owners look at the pools and they say, this is worth fighting for, whether it means future upside or the markets have already recovered and RevPAR is there and occupancy is there and future growth is expected. What makes this a little bit dicier than other things is, had this been one pool of 38 hotels, they could have really cherry picked exactly what they wanted to keep and not keep. The fact that it was pooled, I think that they probably had to make kind of more or less granular decisions and say, all or nothing, we're in on pools C, D, and E, and we're out on A, E, and F. And that probably tied their hands a little bit. But I do think that, to your point, it is really just math, right? We look at these things. What has happened in the past is water under the bridge for us. And it's only what we see going forward, with the one caveat about taxes that we talked about a few moments ago. And by the way, I misspoke a moment ago with regard to Ashford and Braemar. Braemar did not take over those hotels from Ashford. The entity was renamed Braemar after having been named Ashford in the past. So I correct myself there.
And we'll pause for a moment with a message from our sponsor this week. This episode is sponsored by Better Pitch, the experts in private equity pitch deck design. Whether you need a fundraising, corporate overview and track record deck, or investor reporting collateral, they have you covered. Better Pitch has developed pitch decks for raises as small as $1 million and as large as $500 million. The best part? Better Pitch completes all design, copywriting, and market research. Better Pitch is the plug-and-play option to deliver an institutional quality deck, and they deliver the final product in a PowerPoint file for you to use on future deals. Visit betterpitch.com today to learn more. And we have another hotel story this week. This was one that we actually predicted would be impacting the July delinquency rate, and it's an update on the Park Hotels and Resorts loan.
Yes, this was big news last month when it was announced. Park Hotels revealed that they were no longer going to cover debt service shortfalls for the Hilton San Francisco Union Square or the Hilton Park 55 hotels. It's a $725 million debt package backed by these two hotels. In total, they add up to almost 3,000 rooms. What was expected in June became reality in July. Those payments were missed, and that loan is now 30 days delinquent, and that will put more upward pressure on the hotel delinquency rate when we publish it at the end of July.
Yeah, pretty significant news on the San Francisco. It's not breaking, as you mentioned. We've known about this for last month. But again, given the headlines, it was important for us to wait and see that they actually didn't make the payment, which they didn't. And then, as Haley mentioned, we'll see what the impact is on the delinquency for that sector, coming up later this month. But it'll definitely impact the overall delinquency rate for the hotel sector. This is a pretty big deal.
We did see a couple of green shoots this week. The first one, happy to report that the W Chicago City Center loan was paid off this month. This is a $76 million loan that was to mature next month. Why was this so impactful? Several reasons. Reason number one is Chicago has not been very kind to hotels over the last couple of years. Lots of defaults, lots of delinquency, just as with New York and San Francisco. So in this particular case, the borrower used cash on hand to pay off this note. They didn't refinance it. So a vote of confidence there. Also, I like the fact that this loan had been delinquent for almost a year. DSCR was negative in 2020 and 2021 and was still below 1.0x for the 12 months ending in March 2023. Even with all of that negative news, the borrower said that they were going to reach into their pocket and pay off this debt this month. So a nice green shoot there. We also look for something later this week from us with TreppWire. A big New York City Times Square hotel, a Hilton, got a 2-year extension, which is another green shoot. We'll report on that in TreppWire in the coming days. So some good stuff there in the hotel market. Happy to report on that.
Yeah, especially for Chicago. We've been pretty hard on Chicago, whether it be retail, office, or hotel. So it's good to have a green shoot coming out of the city.
Let's talk about office now. And to start, we have another big trading alert that we sent out to our clients today, letting them know about a big California office loan.
Yeah, I have to give kudos both to Haley and to one of our really top analysts, Jack LaForge, because they put up with a lot of my pinging them by text or email at 9 or 10 or 11 o'clock at night saying, this story is breaking. We got new data from the servicers or trustees today about this. We want to get this out right away. So I really value their dedication to the cause. Last night, the story was that the 600 California Street asset in California, this is a $240 million CMBS loan. It's with a special servicer. It went delinquent a month or two ago. The big news yesterday was that the value of the property has been cut by almost 50%. This asset, you might recall, was a little unusual. The major tenant in the property was WeWork. So you had a WeWork concentration there, which everybody was a little skittish about going back 4 or 5 years, just how much WeWork concentration they were sitting on in their portfolios as tenants. This had a little wrinkle in it that an entity tied to WeWork was also the owner of the property. So a double whammy of WeWork exposure. A couple months ago, WeWork indicated they were not going to make rent payments any longer. That caused the loan to become delinquent. Yesterday, we learned that the value of the property had been cut from $350 million in 2019 to $183 million most recently. So that $240 million debt package is now negative equity about $50 million. So not a happy story there.
Yeah, you mentioned the WeWork skittishness there, man. So I remember there was kind of a pretty popular discussion at the conference circuit for a while of, whether it pertains to individual buildings or even in a pool of loans, how much WeWork exposure were investors willing to take, just because they weren't sure of the business model. And in this instance, where you had an entity tied to WeWork as also the owner, I think you're seeing that unfortunately it didn't work out.
We did have a lot more office stories. I'll bucket them very quickly. In the sublease category, the negative ones, not too many. The big one was that in Dallas, Amerisource Bergen, which is, I guess, a pharma firm, is looking to sublease 300,000 square feet in Carrollton, Texas. People are estimating that this could come at a 25 to 50% discount on what AB is paying right now. The story comes from the Dallas Morning News. The interesting thing there, Lonnie, the property only opened in 2019. So it just goes to show how quickly some of the winds can change in the office market, especially when you go through a pandemic.
Yeah, and this was a build to suit property. So new construction, opened in 19, 25 to 50% discount does not sound great.
Also on the negative side, this is in Columbus, Root Insurance. They had already given back some space in that market. They're now looking to give back more space at 80 on the Commons in Columbus, Ohio. They're the second biggest tenant in that particular property. On the more positive side, in the office segment, this comes from the Puget Sound Business Journal, Alec Halverson, who we seem to mention every 2 or 3 weeks. Flexport, which is a logistics startup, is taking over about 55,000 square feet from Amazon. We've been kind of bearish on the Seattle market for a while. Lots of tech firms giving up big swaths of space. In this particular case, a small green shoot with some of that sublease space being taken back. On the new lease segment, we have a story in Boston. This comes from Commercial Search, from Madalena Pohaga. I hope I'm pronouncing that correctly. Millennium Partners has landed Deloitte as a new tenant at the Winthrop Center. This is at 115 Federal Street in Boston. The 140,000 square foot lease is the biggest in Boston in 2023. So a good news there. So we have some happy news in San Francisco. This is from the San Francisco Business Times. As we all know, First Republic, big presence in the Bay Area, 400,000 square feet at 1 Front Street. The question was, what was going to happen to that space once JP Morgan took over First Republic? The San Francisco Business Times is reporting that JPM will keep 75% of the space of First Republic in that particular property. So we were afraid that maybe JPM would say hasta la vista for that 400,000 square foot property. They're going to keep about 300,000 square feet there. So again, a modest green shoot for the Bay Area. Happy to report that one.
So let's circle back real quick, Manus, to your update on the Deloitte lease signing. They took 140,000 square foot. I thought one of the interesting nuggets from that article was that they plan to move all 3,100 employees to that new location. So that was an interesting tidbit relative to that lease signing, and hopefully good news for the return to office contingent that's out there that is part of our listener base. So in the Boston market, this comes on the heels. The Boston mayor and a few others made some announcements this week that they were going to start the consideration of, property tax abatements and credits for office to residential conversions. So it'll be interesting to see if that grabs a foothold. But again, great story for that market with the signing of this, 100,000+ square foot lease.
Well, that reminds me, I forgot about the 3,100 workers that are there. Did you do the math? That's 62 feet per worker. That makes me think like you're working in a submarine, or remember like in Europe, they talked for a while that they're going to have planes where people didn't sit anymore. Like you'd you'd stand and you'd lean forward into this device and they'd strap you in by the back. This makes me seem like we're not going to have a cubicle there, right? You're going to be like, they're going to slot you in a tube, like a pneumatic tube. You're going to go up to this place and you're going to have just enough air to breathe. And maybe like your elbows are going to rub against the person next to you. That's like unsanitary.
Well, and it's not practical. I mean, I think, I'm on the younger tier of like this open office concept that started a few years ago. And like the background noise when you're on a call, or the background noise when you are the background noise, when you're just having a conversation with your coworker is really difficult. And, or when they're on a Zoom and you don't know and you walk by and only half of your body's shown on the screen. So in this case, maybe it eliminates that. But to your point, it sounds like they're going to be, definitely too close for comfort.
I have this image of like a guy comes in on a Monday and he's got a little bit of poison ivy on his forearm. And then the guy next to him has poison ivy. And then the guy after him has poison ivy. And before you know it, everybody in the office has poison ivy.
Oh, and unfortunately, that probably would become like every other Monday type of thing where half the office has to be out because they accidentally or intentionally gave each other poison ivy so they could work from home for 3 more weeks.
Okay, let's move on to retail. We have a mix of stories this week.
Just a couple this week that we were following. From Georgia, the $136 million Oglethorpe Mall has missed its balloon date. The loan is now with a special servicer. This is a 600,000 square foot property in Savannah, Georgia. Why did this catch my attention? First of all, both pieces of the loan are part of CMBX 7. So something to watch for those that play in that space. The other thing that caught my eye is that this has been a pretty strong performing asset. DSCR most recently was 1.50x. Occupancy was 94%. The loan has been amortizing. And yet, even though there's not a whole lot of debt on this particular asset, not refinanceable, at least on time. So this particular mall now delinquent and with the special servicer. A more positive story, this comes from Jacksonville. The $110 million The Avenues loan has been extended, something we've seen over and over and over again in the retail market. In this particular case, the loan was extended from 2023 to 2026. This is a 600,000 square foot property, as I said, in Jacksonville, and it backs a 2013 CMBS deal. Noteworthy again here, this was really strong collateral. DSCR was well over 2 in 2022 and 2021. So a really strong property, and yet here we go again with a need to extend.
Yeah, at least they were able to get the extension though. And if you look at the occupancy, even though the DSCR numbers have been good, occupancy has been below 70% since 2019 when Sears closed. So it's definitely kind of one of those, malls where it's on paper looks good from a cash flow perspective, but if you probably walk it, feels a little bit empty on the inside.
And we did have one more sale here that I wanted to highlight. I always get a chuckle because every single week I hear of a retailer or a restaurant that I never heard of before. This particular story comes from Benzinga and Lekha Gupta. Four Corners Property Trust acquired 13 restaurants. One is an Olive Garden. I've been to an Olive Garden once, and it was underwhelming, I have to say. One of the comedians does a riff on that about bologna Alfredo. The other property is 12 Cheddar's Scratch Kitchen. Never been to one of those, never heard of it before. It's not pulling me in.
Yeah, so there's a bunch of Cheddars in Texas. There's a bunch of Olive Gardens in Texas. And in fact, I hope you haven't offended the Olive Garden free, all you can eat, or maybe not free, but all you can eat breadstick community that's out there that may be listeners of the podcast. So if you do go to Olive Garden again, Manus, I would encourage that you try the breadsticks because they are pretty good. And Cheddar's, it's okay. If you're in a pinch, you need a quick casual sit down meal, it's all right for $20. Pretty good little hamburger or something like that.
I was kind of shocked at the price for 13 restaurants. I think of like a one-off restaurant as like a $4 or $5 million asset. And we were thinking about 12 or 13 of these things, you're thinking about a price tag of 60 million, 65 million, $80 million for 13 restaurants. That seems like a lot of breadsticks.
Yeah, there's a lot of breadsticks. I will say a lot of these cheddars, at least in Texas, there's been a pretty large expansion of them. So they are newer construction and better locations. And if there's long-term leases in place, maybe there's a play there. But yeah, I would agree with you. The price tag does seem pretty hefty, especially given the scale at 13 restaurants. You think you'd be buying it maybe at a little bit of a discount. Not the case here.
Yeah, I want to come back to this higher price. I just want to close the loop on something we did during our open, because maybe this is the start of something. This seems like a hefty price for me. And when interest rates fall, cap rates usually follow. And this will be a really interesting thing, Lonnie, for the next 30, 60, 90 days. Is this the beginning of a new run up in prices now that we're seeing, we didn't tie back falling rates and falling spreads to cap rates, but if this sticks, we could start seeing a reversion, right, in the next couple months to say, not only are people getting on board in buying equities and buying bonds, it's spilling over into the cash flowing commercial real estate hard asset space. And we may be looking at, a reversal, right? What do you think?
Yeah, I think it's still early for me to kind of say, yeah, I think that's possible. I think mathematically, yes, you're 100% correct. If this stays, like, we're going to see a little bit of a reversal. It's interesting though, because I don't think we actually saw cap rates reset with the interest rates to the level that they probably need to. So even with this like small reversal from the Treasury perspective and overall interest rates with the spread collapse, like, I don't think we're going to see a bunch of cap rate compression. But I do think we'll see people willing to take on more risk, as you mentioned, and we'll see more activity. We just released the Trepp Property Price Index, which kind of goes through paired sales and what's happened to values. But it seems like every week we'll have kind of one or two of these anecdotal stories where the price is really surprising on the high side. So even with all the turmoil, it seems like deals, not at scale, but deals, singularly deals are getting done at higher than what is expected from a price perspective.
And we have a programming note this week. So in case any of you missed it, we launched our Trepp CLO product a few weeks ago. That is our leveraged loan and corporate CLO analysis tool. So we're actually hosting a Trepp CLO webinar next week on July 19th to kind of walk through the state of the corporate CLO market and then also give an overview of the product. So if you're interested in that, reach out to us at podcast@trepp.com and we'll get you that invite link. And let's turn to shoutouts. So we had a very cool one today. Soichiro I from Tokyo reached out to us to let us know that he's a huge fan of the TreppWire podcast and he really appreciates all we're doing here. He says because we release it on Thursday nights, it's Friday morning his time, and he listens while he's going on his weekend grocery store runs. He said that although he's based in Tokyo, a lot of the topics we discuss provide very good insights into what's happening on that side of the globe as well. So thank you, Soichiro, for letting us know.
Imagine a live podcast from Tokyo. I've never been to the Far East. It's on my bucket list. I'd love to go, and maybe go there and take it on the road, right? What is that, 3,000 miles? That would be quite an event.
This might be another request for Simon.
Simon H. Paging Simon H.
Todd C. said he's a longtime listener and he subscribes to the data, so he's a client as well. He was interested in some of our loan maturities information, which we talked about last week. So reach out to us if you're looking for that as well. So Jacob M. said that he would like us to have a discussion on debt funds. So that's something we'll talk about in the future. He also gave us suggestions for some of our listener names. He said Treppies or Treppers. But I forgot to mention this in my email back to you, Jacob. Treppies is actually what our employees are called. So if you would like that name, anyone out there, you'll just have to come and become a Treppy and work with us. David H. said he greatly enjoys our podcast. Our own Tyler T. said that she chuckled at your Walgreens lozenge comments last week, Manus. Derek T. Niraj A. said great job on the past week's podcast. Micah L. said thanks for putting out amazing info and always being willing to share it. So if you guys ever have questions or thoughts, you can always reach out to us. Brent E. said, you three on the podcast are definitely the coolest folks in the world. So that was to a comment we made last week. So thanks, Brent. You might be the only person who thinks that.
I thought Manus just Venmo'd him $100 or something. That's what I was
He
thinking.
might have. The Trepp Nike golf shirt he sent him. KCO said, your team does an incredible job and I look forward to it every week. Ben K said he's an attorney and this podcast has helped him educate on the business side of what's happening with commercial real estate. Patrick P is an undergraduate student who's been listening for the past 6 months. Isaac R loves the pod. Austin R said, great work. Matthew E said, this podcast sets his day in the CRE mood. So there you go. And then a bunch of other people reached out for some of the offerings we had last week, whether it was our property price index, defeasance calculations, or multifamily NOI report. Kamakashi B, Leah V, Austin S, Wilson A, David E, Bob P, Anna S, Tyler S, Chris V, Justin G, Jeff R, and Brent H. And with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.